Hi, I'm Linda Eedes, and today I'm going to give you an update on the RECM Global Felxible Fund. Just by way of reminder, this is our multi-asset class fund. It's fully flexible and it's measured in rands. What that means is that it allows us the opportunity to invest either locally or globally across all asset classes wherever we see value, with the objective of returning in excess of 6% above inflation per annum over time. So looking at the fund's returns year to date, there's been a nice recovery in the performance. Obviously, we've got quite some way to make up the performance that we lost over the last few years, but certainly nice to see some of the stocks which actually caused the pain in the portfolio rallying significantly during the year to date. So if you look at the returns of the portfolio to the end of April, it was up 14.9%, and that needs to be viewed against a backdrop of the global equity market, the MSCI All Countries World Index, which actually was down by 6.5% for the year to date to the end of April in rands. The all share fared a little bit better. It was up by 5% also to the end of April. So we still think that those stocks are significantly undervalued. We think that the resource sector is still a great opportunity, and that's why you will still find about a third of our equities invested in that part of the market. But certainly over the last year, the market has provided us with the opportunity to diversify the portfolio more into other areas of the market. Looking at the positioning of the portfolio currently and versus how it was positioned towards the end of the year, two notable things. First of all, we've actually pulled back our global exposure, both on the equity side and the cash side. Most of this has actually gone into rands, in other words, into cash. But there has been a little bit of an increase in the South African equity component as well. The main reason for this has been the undervaluation of the rand relative to the dollar and other global currencies, but in particular hard currency. And the rand, as it stands, is at another low. And we just think that the rand is significantly undervalued if you look on a long-term basis, taking into consideration inflation differentials. And that has a significant impact on the discount to fair value of businesses priced outside of rands. So we're sitting with a portfolio which has about 65% in South Africa and about 35% globally, and that's made up globally of a portion of cash as well as equity. And locally, the other major action which we took was to actually introduce 3% in South African bonds, and in particular a 20-year government bond. You saw yields have come up quite considerably over the last few months, and we are now getting a return in excess of 3% above inflation from bonds, which we believe is a commensurate return for the risk of lending to the South African government. So we now have bonds in the portfolio to the tune of about 6%, 14% in South African cash, and about 44% in South African equities, if you include the preference shares with the South African equity component as well. So looking at the top 10 stocks in the portfolio, you can see that quite a few of those are still resource companies. We still think that this is an overwhelming opportunity in the marketplace, but one has to be careful about where one has exposure. And we see that we've got Implats, BHP Billiton, Anglo American, and Amplats still feature very strongly in our top 10 stocks in the portfolio. BHP Billiton was one we introduced in the fourth quarter of last year, which was part of our strategy of upping the quality of the resource exposure as the market offered us the opportunity to buy those businesses at significant discounts. A year ago, however, you would have seen far more resource counters in that top 10 list. So what this is also a function of is the fact that the market has provided us with the opportunity to actually diversify the composition of the equity component of the portfolio, which of course is a desirable thing. If you look at the other names in that top 10 list, you can see they're both industrial and financial stocks there. HCI gives us exposure to the gaming and leisure segment of the market through, in particular, their holding of Tsogo. RECM and Caliber is actually our permanent capital vehicle. It's a preference share, which is a joint venture between us and Caliber Capital Proprietary Limited, and it allows us to actually pursue opportunities without worrying about the liquidity because we are investing permanent capital, and we've got a really good mix of businesses in that portfolio, which include gaming, retail, mining, engineering, food producers. And that underlying portfolio is very conservatively valued, with the preference share trading at a discount, even that valuation. Other interesting stocks in the portfolio are the inclusion of banks such as Standard Bank and Nedbank. Both of these banks are trading at multiples which we believe do not reflect their through the cycle worth. And obviously this is on the back of a lot of negative sentiment following, of course, the whole Nenegate saga, as well as obviously a sort of rising interest rate climate. Lastly, we have an interesting investment at the bottom of the list, which is Eedes Investments. Particularly interesting because this is one of those stocks which we wouldn't be able to buy if we weren't the size that we are. So our assets under management give us a significant opportunity to actually invest in great businesses like Eedes. This is a 3 billion rand market cap company. They have gaming assets, including Vukani Gaming Corporation and Galaxy Bingo. And they also have a large stake in wine and spirits producer KWV. Now, Vukani is the largest limited payout machines operator nationally, and Galaxy Bingo has a large market share in the electronic bingo market in South Africa. And these are both very strongly growing markets in South Africa. Both well-managed businesses, which we believe will go from strength to strength. And very recently, Eedes actually announced plans to sell their operational assets of KWV, and the terms of the agreement actually represented a significantly higher value to the assets than was originally assigned by the market. So looking at the portfolio as a whole, we've got a really nice mix of value opportunities, both locally and globally, across a wide mix of industries and businesses. And we still have a sizable cash component that we can put to use as those further opportunities become available through market volatility. Thank you.